Most people believe a common myth. I need thousands of dollars to start investing. Because of this belief, millions of hardworking people put off investing for years, waiting for the right time or enough money. A day that rarely comes. They assume the stock market is an exclusive club reserved only for the wealthy or financial experts. Here is the ultimate truth. You do not need a fortune to build long-term wealth. You simply need to start with what you have right now. Even if it is just $10, $25, or $50 a month. Think about it this way. If you can afford 1 cup of takeout coffee a day, a single restaurant meal a week, or a couple of unused digital subscriptions, you already have enough capital to start building your financial freedom. Investing isn't about being rich today. It's about taking small, intentional steps today so your future self can be financially secure. In this video, we aren't just going to share abstract theories. We are giving you a comprehensive, step-by-step roadmap to start investing with small money, eliminate the fear of losing your capital, and put your money on automatic growth starting today. Before you invest your very first dollar into the market, you must secure your financial foundation. Investing inherently carries market fluctuations. If you invest money that you immediately need next week for rent, groceries, or utility bills, a sudden market dip will terrify you into panic selling at a loss. To prevent this, you need 2 basic pillars in place. First, tackle high-interest debt. If you carry a credit card balance with an 18% or 20% annual interest rate, paying off that debt gives you a guaranteed 18% or 20% return on your money. No stock market strategy on earth can promise a guaranteed return that high. Clearing high-interest debt is the absolute best investment you can make first. Second, build a small emergency cash cushion. Set aside $500 to $1,000 in a high-yield savings account that you can access instantly. This is your financial shock absorber. When an unexpected car repair or medical bill happens, you won't be forced to pull money out of your investments at a bad time. Once this cushion is built, every extra dollar you save can safely go toward building wealth. Why does starting small actually work? Because time does the heavy lifting for you through the incredible power of compound interest. Albert Einstein famously called compound interest the 8th wonder of the world, stating that those who understand it earn it, and those who don't pay it. When you invest, your principal money earns a return. The following year, that original money plus the return earns its own return. Over time, this creates a massive exponential snowball effect. Let's look at real-world numbers based on an average 8% historical annual market return. If you commit to investing just $50 a month, which breaks down to less than $1.70 a day, in 10 years, you will have personally contributed $6,000, but your total portfolio will grow to nearly $9,200. In 20 years, your total personal contribution of $12,000 transforms into over $29,000. And in 30 years, that small, consistent $50 a month turns into over $74,000. Look closely at those numbers. You only put in $18,000 of your own money over 30 years. But compound interest handed you over $56,000 in pure profit for free. The key variable isn't how much money you start with,
It is how long you let your money compound.
Now, let's get down to execution. Where do you actually put small amounts of money today? Here are 3 beginner-friendly gateways. In the past, if a single share of a major tech giant cost $500 or $1,000, you couldn't invest unless you had that exact amount. Today, modern regulated brokerage apps offer fractional shares. This means you can buy a tiny piece of that same world-class company for as little as $5 or $10. You own a slice of the pie regardless of your budget. Second, low-cost index funds and ETFs. Trying to pick individual stocks can be risky and time-consuming, especially for beginners. Instead, you can invest in an index fund or exchange-traded fund like an S&P 500 fund. When you buy one share of an S&P 500 ETF, your money is instantly split across 500 of the largest and most successful publicly traded companies. If one company performs poorly, hundreds of others balance it out, giving you instant diversification and lower risk. Third, automated robo-advisors and micro-investing apps. If you prefer a hands-off approach, automated investing platforms can build a diversified portfolio tailored to your risk tolerance. Many of these apps even feature round-up settings that round up your everyday debit card purchases to the nearest dollar and automatically invest the spare change. Part 5. To protect your money and ensure long-term success, lock these 3 cardinal rules into your strategy. Rule number 1. Automate your contributions. Do not rely on willpower. Set up an automatic recurring transfer of $10, $25, or $50 directly from your checking account to your investment account every single payday. When you treat your future wealth like a non-negotiable monthly bill, consistency becomes completely effortless. Rule number 2. Don't try to time the market. Trying to guess when the stock market will hit its bottom or peak usually leads to emotional decisions and financial losses. Instead, practice dollar-cost averaging, investing a fixed amount regularly, regardless of whether the market is up or down. When the market is down, your $50 buys more shares at a discount. When it goes up, your portfolio increases in value. Rule number 3. Ignore get-rich-quick hype. Speculative cryptocurrencies, meme stocks, and high-risk day trading options are lotteries, not investments. They often wipe out beginner accounts overnight. Real generational wealth is built quietly, steadily, and patiently over time. Here is your personal challenge for today. Don't just close this video and go back to your routine. Take immediate action. Download a reputable, regulated investment app available in your country. Complete the simple setup process and schedule your very first small deposit, even if it's just $10. The best time to start investing was 10 years ago. The second best time is right now. Start small, stay consistent, and let time build the financial security you deserve. If you enjoyed this video and want to learn more about money, investing, and building wealth, subscribe to Wealth Pilot for more valuable content. Thanks for watching. See you in the next video.